Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. Tighter financial conditions seems to put the brakes on the fast pace of growth. One of the latest examples of this is Australia, where the retail sales for the month of December came in much lower than expectations at minus 3.9% against expectations of minus 3.3%. China, on the other hand, posted strong services PMI number backed by reopening of the economy. This week remains crucial in terms of the events lined up. Let's hear from JK on the latest developments. Over to you, JK.
Good morning. So the risk sentiments took a slight setback yesterday after another set of higher than expected inflation number, this time from Spain and Belgium. And this is after a similar beat on the number in Australia and Japan. Now, market is nervously looking at numbers due from Eurozone tomorrow, that the inflation number, flash inflation number actually, even as they brace up for hawkish ECB on Thursday. The difference this time is usually Eurozone inflation number is preceded by German inflation number, but apparently due to some technical problem, the number of Germany will be published later. Adding to the bad news was GDP number from Germany yesterday, showing a negative growth of 0.2%, in a sign that Europe's largest economy may be entering a much predicted recession as an effect of the Ukraine war. And the year-on-year growth was 1.1 versus 1.3 expected, the previous being 1.4%. So the decrease in fourth quarter means a recession, which is commonly defined as 2 successive quarters of contraction, has become more likely, as many experts predict the economy will shrink in the first quarter of 2023 as well. So we have negative growth for Q4 22 and negative growth for Q1 23, makes it a case for the country, the largest country in the Eurozone, being under recession. So with inflation remaining high and growth taking a hit, are we looking at a stagflation in Europe's largest economy is the question that investors are now grappling with. Data showing improved economic sentiment indicator could not boost the sentiment much as the manufacturing survey of Dallas region in the US continued to show decline, though at a slower pace in Germany. Global stocks have retreated on Monday after 6 sessions of gains, while US Treasury yields rose ahead of the central bank policy announcements and data that might shed light on whether progress has been made in bringing down inflation, even as data show economic activity is slowing in various sectors. There is also a good number of analysts who think, including me, that Fed may continue to sound hawkish and push back against markets' expectation of an early pause or a cut later in the year. Tech giants like Apple, Google, and Amazon are also expected to announce the results this week, adding to markets' anxieties. Global Composite Index yesterday closed almost 1% lower, and Nasdaq, which had made handsome gains so far in the year, closed almost 1.7% lower. Yields were led by a jump in German yields, or rather the European yields after the Spanish inflation number beating expectations. And this also led to US yields moving up. German 2-year was up by 10 BPs and 10-year by 8 BPs. And US Treasuries in the 2-year was up by 5 BPs and 10-year by 4 BPs. On the currency front, major currencies are still holding tight ranges, but showing tendency to correct ahead of the key policy decisions by Fed, BOE, and ECB. Japanese think tank yesterday had called for Bank of Japan to make 2% a longer-term inflation target instead of one that should be met as soon as possible, in the light of costs of prolonged monetary easing. Surprisingly, yen weakened after this towards 130.50. Possibly listening to Kuroda, who said that monetary easing will continue, for some more time. However, yen has held in the 1 week, 1 yen range for quite some time, and that has continued. While Euro and GBP are holding just under the recent highs, fears of stagflation in both these countries are lurking, particularly after negative GDP number from Germany. Even Australia reported a 33-year high reading in inflation, but retail sales slumped to minus 3.9% in January versus expected minus 0.3%. So we have a very mixed picture on the global economy, and possibly high inflation not going away in a hurry, and growth taking a hit. I think that's what is probably going to guide the investor approach in the coming days. Of course, how the Fed sounds after their rate decision, where they are very likely to hike rate by 0.25%, will also be important. On the rupee market, despite meltdown in equities and large outflows to the tune of nearly 2.5 billion USD seen from FIS this month, the currency has managed to hold below 8180 resistance, thanks to some investments received from two large global investors for the ongoing Adani IPO, and also state-run banks capping the volatility as well. While the recent large fall in equities can be seen as a technical correction or consolidation, the question of whether FIS found the valuation correcting enough will determine if we get fresh inflows. Union budget tomorrow can be directed to attracting foreign investments in the form of FDIs, investments under PLI scheme, and a small probability of a final decision on including Indian bonds in the global bond index by offering the tax concessions that has become a stumbling block. The bond inclusion decision has the potential to change the game for the rupee. Finally, we have a data slate getting thicker this week from today onwards. US employment cost index, consumer confidence, Chicago PMI, and housing price data today, to be followed by more important economic and policy events from tomorrow. Just ending with one statement from the Nobel laureate Paul Krugman. He says he's worried that the markets are getting ahead of themselves and warns that the market pricing that inflation is over could be a self-denying prophecy if easier financial conditions reignite the price pressures. Thank you. Have a nice day.
Thank you, JK. And as JK mentioned, there were higher than expected inflation numbers from Spain and Japan, while German GDP numbers came in lower, sparking fears of a stagflationary situation. We saw a retreat in global stocks, while US yields were stabilizing on the higher side. While there are key policy decisions coming up, we closely follow the commentary of the Fed to assess whether they sound hawkish. These interpretations might give further direction for the dollar. That's it from us today. Keep managing your risk. Thank you so much for listening.